Today, the S&P 500 and broadly the US equities market dropped, but the S&P 500 in particular dropped by about 3% just today alone, sending the equities market in the US into a tailspin. But what if I told you that amidst this chaos, there are ways to profit from this? And join me as I dive into the challenges of making money in a down market by exploring some options that I consider in situations like this. First of all, let me be clear. Investing and trading comes with risks, but with the right knowledge, there are opportunities of making money potentially. Now, making money in the down market is potentially something that is usually seen as a myth. And yes, there are, of course, quite some risks, but I'm here to show you some of the opportunities that I use. Now, the first thing is to understand the market dynamics. Usually, when the market drops, one thing for sure is that most people are fearful and they start to panic, right? And these are the usual reactions. But some investors often see the red as something to just start selling and selling and selling. And yes, sometimes it's time to really sell, right? Now, but this fear often overshadows the opportunity to potentially see some games in this chaos. After all, when everyone is selling, it usually pushes the market down, right? And when the prices get to that level, that's when some companies that are fundamentally are strong can be bought for very cheap prices compared to their valuation and other things that I look at when I'm looking at stocks. Now, the strategy number one that I like to employ is trading the VIX ETFs. That is, the volatility index usually is considered to be stable when it's around 20, right? Basically, it measures the fear, right? If there's a lot of fear in the market, usually it spikes up like it did today. And I'm going to show you that in a second. But when do you know that this is the right time to get in? For me, what I've seen is that usually when the market usually starts, the S&P 500 index, the equities start to hit the all-time high, breaking new highs, the market cannot continue to go up and up and up forever. So below the levels of 20, because usually when the equities market is going up, usually the VIX is dropping, like I will show you in a second. So what then happens is that when there is an unexpected drop in the market, like today, what happened was that the Fed, they reduced the interest rates by 25 basis points, but within their statement, there was something that the market judged as potentially risks. Because, for example, this statement here, for example, it says the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Basically, it means it's uncertain, but it's also further added that the economic outlook is uncertain and the committee is attentive to the risk of both sides. But I will tell you that over the past couple of weeks, after President Trump was elected, the market has been rallying up, right? But the market does not always go up. You can see this huge drop here, right? Now you can see that the SPY, which usually tracks, it's an ETF that can give you exposure to the S&P 500, right? It dropped by almost 3%. You can see now this, the S&P 500 index here. Right now, it's like 2.9, let's say 3% roughly, right? But you can also see that the Dow, which has been in, I think, 9 consecutive down days, it also further dropped by 0.2%. I think it had priced in that. But, sorry, this is the DAX for the German, but the Dow Jones, it went down by 2.58. The NASDAQ, it went down by almost 4%, 3.6. Now, you see what happens to gold, it goes up. Now, you see what happens to the VIX, it spikes up. So, for me, I like to have a hedged portfolio for the VIX through some ETFs that track this, right? Another This is not investment advice, but I'm just giving you an example. You see, this ETF spiked today by 20%, right? 21%, right? But the thing is, at the end of the day, the most important thing is to understand when this is the right time to buy. You can see the heat map here. Most stocks, they were red. What this means is that there was a sea of red. In other words, there was a sell-off. So for me, I profited from this because I started buying the ETF that tracks the volatility index when most people were saying, oh, the market is going up, it's going to go up. Yes, it might continue to go up, it might go down. But the key thing is to balance the risks. So for me, I like to have leveraged ETFs for this at a certain level once I do my analysis. And that's what I teach people who come to my online courses and also one-on-one coaching to say, look, you really have to understand these things and have a hedged portfolio, but at the same time have some cash, because opportunities like this, tomorrow the market might be up, but it might continue to go down. But if you have cash and you have done your homework of looking at fundamentally strong companies and you had a hedged portfolio, this might be an opportunity to actually make money. Now, some people like to short sell. That means they are betting that the market is going to go down. But the question is, how do you know that the market is going to go down at this point, at this level? Now, the key thing is that the risk in short selling is unlimited, because let's say there's a catalyst like what happened. There were some people who were betting that the market was going to go down with the US election. But guess what happened? Tesla has been going up. The equities market has been going up, right? So if you were short selling, it means you would be squeezed, and basically you're borrowing from a broker. So you're opening a position by selling at a high price, that's borrowing shares, and then with the hope of buying back the shares, hopefully if it drops. But if it goes up, the loss can go on and on. So this is another opportunity, but it's very risky. I don't like to use this option of short selling. I like to just look at securities like ETFs that track the VIX, right? When it goes to a certain level, when the equities market like the S&P 500 starts to hit all-time high and it continues to drop, I like to have a small portion, maybe 10-15% in that particular category, and having some cash. That way, for me, if the market drops, that unexpected spike can potentially propel the portfolio and give an option to possibly take some profits and even buy equities when they drop. Now, another strategy is to consider some undervalued stocks. At any given time, there are stocks that may be, undervalued. That means you have to understand valuation, and that's what I teach when people come to my one-on-one coaching. But the thing is, you really have to understand valuation, but sometimes it's extremely difficult to pick those stocks. But it's one way that I look at the stocks that are hitting 52-week low and all this, and I take time to analyze them, and it takes some time. And then once I believe that these are fundamentally strong companies, I look at their free cash flows, understand their sector, and also because stocks, they are inside catalysts, but also macroeconomic conditions. For example, today the Fed just dropped the interest rates by 25 basis points, yet in their prepared statement, there were nuances that the market deemed to say potentially in the future they may not decrease the interest rates as they expected. Because what happens with the market is forward looking, right? Investors expect that if I buy shares for this stock, it might go up by 20%, 30%. Now, if it doesn't go up by what analysts and most people or the market is expecting, it can possibly correct, because people may panic, may start to sell off. Now, that's the psychology of investing or trading. Sometimes also another strategy is to just keep some cash, okay? If I have some cash, that means I have the ability to add more shares on wonderfully strong companies when they really pull back, let's say by 30-40%, if there is no fundamental or structural change. Today, it was the issue of the Fed. Chair Powell just and the committee, they decided that they want to reduce the rates by 25 basis points, which the market expected. But like I said, the statement, there were some nuances, and there will be some other nuances about what they expect in the future in terms of the focus, what they call the dot plot, to say, do they expect the economy to continue going up? Again, there are a lot of nuances. There's politics, there's the upcoming Trump administration. A lot of people are expecting deregulation, but I think the market had really gone up. But 3% in the S&P 500 was in one day, it was a big drop. Actually, I think it was the first major drop after March 2020 when the COVID epidemic happened. So, in conclusion, the other option is to look at uncorrelated stocks. For example, some people, they like gold, and I just showed you that gold ETFs, right? For example, it went up when the overall market was going down. This is something that is theoretical, but sometimes there are nuances. So the key thing is that, remember, making money in the down market isn't just about luck. You really have to be strategic. For example, I like to make informed decisions and also spotting opportunities when I see some limited risks. But always I like to manage my risk. And this is not investment advice, but remember, the market is unpredictable. And what works today may not work tomorrow. So at the end of the day, there's need to really constantly understand what's going on in the market. And now I want to thank you for watching this video. And if you found this breakdown helpful, consider subscribing to my channel for more insights on navigating the markets in all conditions. Also, don't miss my free weekly newsletter at www.streetwiseeconomics.com for exclusive financial highlights. Share your thoughts on the down market strategies in the comments below, and I'll see you in the next video. Trade and invest wisely, and may the markets be on your side. Bye bye for now.